Every major banking collapse in modern history, no matter the country, the political system, or the decade, has followed an eerily similar four-layer pattern. It doesn't matter whether we look at the thousands of banks that failed during the Great Depression, the collapse of Lehman Brothers in 2008, the Cyprus banking crisis in 2013, or the Lebanese banking implosion in 2019. When you strip away the local details and the headlines of the moment, each of these events moves through the same stages in almost the same order. Almost like a blueprint that repeats itself even when no one recognizes it happening in real time. And what almost more unsettling is that many of these layers appear to be forming again in today or S financial world, with signs that look strikingly similar to those seen at the beginning of previous failures. It's a pattern that's easy to ignore when markets appear stable, but impossible to unsee once you understand how it unfolds. At the center of this recurring pattern is the first layer, an invisible structural weakness that builds quietly inside the financial system long before any crisis is recognized. This layer is rarely talked about while it's S forming because it doesn't usually appear dramatic. In the years before the Great Depression, for example, banks expanded aggressively into risky loans, encouraged by an environment of speculation and rapid economic expansion. Yet, to the average depositor, everything looked normal. Branches opened, credit flowed, and the headlines celebrated growth. The same happened in the years before 2008, when mortgage-backed securities and financial engineering masked the fact that banks were holding assets far riskier than they appeared on paper. Regulators believed the risks were diversified. Rating agencies stamped them with high grades. Investors assumed the system was robust. Few people noticed the invisible weaknesses accumulating beneath the surface. This hidden fragility pops up in different forms in different countries. Before the Cyprus crisis in 2013, banks had outsized exposure to Greek government bonds, a fact that didn't seem alarming until Greece itself was in trouble. In Lebanon, years of financial mismanagement and an unsustainable government debt system created vulnerabilities that were widely known but rarely treated as urgent. Depositors continued to trust the banking sector because the system had worked for decades. The invisible weakness isn't always about bad loans or risky investments. Sometimes it's about overexposure to a single sector, excessive leverage, or a mismatch between short-term deposits and long-term assets. What matters is that the weakness is usually hidden, technical, and misunderstood by the public. People assume that because banks are part of the everyday landscape, they must be stable. This assumption is exactly why Layer 1 often goes unnoticed until it's too late. Once this unseen fragility grows large enough, the system shifts into the second layer, the liquidity squeeze. This is the phase where stress turns visible, but only to those who know what to look for. A liquidity squeeze happens when banks begin struggling to access or maintain the cash they need to meet withdrawals and short-term obligations. It doesn't immediately mean the bank is insolvent, it simply means it's running out of liquid money. This can start with small signals, like banks quietly borrowing more from central banks, reducing lending, or offering unusually high interest rates to attract deposits. Before the Great Depression bank failures, small cracks became apparent when certain banks began limiting withdrawals. Before the 2008 crisis, institutions began refusing to lend to each other in interbank markets because no one trusted the value of the assets being used as collateral. In Cyprus, the liquidity squeeze became undeniable when banks shut their doors temporarily, claiming operational reasons while internally fighting to cover massive short-term gaps. In Lebanon, banks gradually reduced access to dollar withdrawals, then limited international transfers, then imposed informal controls long before the public fully realized what was happening. Liquidity crises are dangerous, not because they reflect the final collapse, but because they accelerate it. When a bank begins to lose liquidity, even small rumors can escalate into full-blown panic. This is also the moment when ordinary people begin noticing something is wrong, even if they can't explain it. It's the uneasy stage where someone might comment online, "My bank said I can only withdraw part of my money today," or "Why are transfers suddenly taking longer?" These small experiences, when they repeat across thousands of people, become the psychological spark of a larger crisis. If liquidity stress continues to build, the system enters the third layer, government intervention. This is the phase where authorities step in claiming they are stabilizing the situation. Yet, historically, this stage often worsens public confidence instead of improving it. The form of intervention differs across countries, but the pattern remains the same. In the United States, during the Great Depression, many states declared temporary bank holidays, which only confirmed fears that banks couldn't meet withdrawals. In 2008, authorities attempted targeted bailouts, guarantees, and emergency funding programs. Some actions helped, but others created confusion about which banks were safe and which were not. In Cyprus, the government imposed capital controls, froze deposits, and announced bail-in measures where depositors would take losses. These steps were presented as unavoidable, but to ordinary citizens, they signaled that the crisis had moved beyond technical issues into something far more serious. In Lebanon, government intervention took the form of restrictive withdrawal limits and unofficial freezes on accounts. The more rules they introduced, the more people realized that their access to their own money was no longer guaranteed. Governments rarely intend to worsen the situation, but once the public sees that even authorities cannot restore normal operations, fear becomes rational. This is the psychological turning point where trust begins to collapse. Layer 4 is the moment of public shock, when people realize the system was weaker than they thought. And this stage usually arrives suddenly, even though its roots stretch back years. During the Great Depression, the shock was the collapse of thousands of banks. In 2008, it was the bankruptcy of Lehman Brothers, an institution so large that many believed it could never fail. In Cyprus, the shock moment was waking up to see that a portion of bank deposits had been seized to cover losses. In Lebanon, it was the point when people discovered that their life savings were effectively inaccessible, trapped in a financial system that no longer functioned. This shock moment often brings a wave of anger, confusion, and disbelief. People ask why no one warned them earlier. Some say they noticed small signs, but didn't think they were serious. Others begin sharing their personal experiences, comparing what they saw and when they realized something was wrong. These discussions often spread quickly, and if you have lived through any period of banking instability, you likely have your own memories of small red flags that only made sense in hindsight. These collective reflections play a larger role than most realize, because they are part of how society builds awareness, and sometimes denial, about financial risk. What makes this 4-layer pattern particularly important today is that many of the early signals observed in past crises are reappearing in different parts of the modern financial system. Global debt levels have climbed to historic highs, driven by years of low interest rates that encouraged governments, companies, and households to borrow aggressively. When interest rates rose sharply, as they have in recent years, the cost of servicing that debt increased significantly. Historically, this combination of high debt and rising rates has been at the center of multiple financial breakdowns. Banks today are also heavily exposed to government bonds, especially in countries with large fiscal deficits. Under normal circumstances, government bonds are considered safe. However, when interest rates rise rapidly, the value of older bonds decreases. This was exactly what triggered the stress in several regional banks in the United States in 2023, when depositors suddenly realized that banks were sitting on large unrealized losses in their bond portfolios. That event did not lead to a global crisis, but it revealed a structural vulnerability that looks remarkably similar to early signals seen in previous failures. Trust in financial institutions has also weakened in many countries. Some of this comes from inflation cycles that eroded purchasing power. Some comes from political instability, unresolved debt problems, or inconsistent policy decisions. Individually, these issues might not cause a crisis, but history shows that crises emerge when multiple weaknesses overlap. When interest rates are high, government debt is elevated, banks hold assets that have lost value, and public trust is fragile, the system becomes more sensitive to shocks. In past banking collapses, it was rarely one issue that triggered the fall. It was the combination of several pressures that converged at the same time. This brings us to why 2025 is considered by many analysts as a critical convergence point. A large number of countries face debt refinancing deadlines in 2025, meaning they must renew or roll over massive quantities of government debt at higher interest rates. This alone puts pressure on national budgets and can increase the strain on banks holding those bonds. Several political cycles also coincide in 2025, with elections and leadership transitions in major economies that historically create periods of uncertainty. Additionally, global markets are still adjusting to the long-term effects of inflation, supply chain disruptions, and uneven recoveries from recent economic shocks. Banks around the world are carrying stress markers that resemble those present before earlier crises. These include maturity mismatches between deposits and loans, unrealized losses in bond portfolios, and increased reliance on short-term funding sources. When these stress markers appear together, depositors often become more cautious. Even a small rumor or unexpected news event can create a wave of withdrawals. And when that happens, banks sometimes respond by quietly tightening withdrawal limits or adjusting their terms, which in turn fuels more concern. People begin to ask questions, compare experiences, and wonder if something bigger is happening. You may have seen online discussions where people share their experiences with delays, restrictions, or unusual account behavior. These conversations have played similar roles in previous crises, acting as early signals of public concern. When confidence weakens further, governments often step in with capital controls or emergency measures. While these steps are designed to protect the system, they can also make depositors even more anxious. Bail-ins, where depositor funds are used to stabilize banks, become more likely when government resources are stretched thin. This is not a prediction, but a historical observation. Whenever a government lacks the financial capacity for a bailout, the burden shifts to depositors. Cyprus in 2013 is the clearest example, but it is not the only one. Lebanon's financial collapse showed how quickly access to money can change when the system becomes unstable. These cases highlight why understanding the four-layer pattern matters. When early weaknesses go unnoticed, they eventually lead to moments where ordinary people pay the price. As 2025 approaches, the world is entering a period where multiple risks overlap. This does not guarantee a crisis, but it increases the importance of awareness. History shows that banking failures rarely begin with the dramatic events that make headlines. They begin quietly in the invisible weaknesses of Layer 1. They grow during the liquidity pressures of Layer 2. They escalate when government interventions send mixed signals in Layer 3. And they become undeniable in the public shock of Layer 4. These lessons are not warnings of what will happen, but reminders of what has already happened repeatedly. Throughout this narrative, you might find yourself thinking about your own experiences with banks, or moments when something felt unusual. Maybe it was a withdrawal limit, a delay in a transfer, or news about a bank you use. These observations matter, and sharing them often helps others understand the broader picture. Many people underestimate how often public awareness builds from individual experiences. If you've ever wondered whether others have faced similar issues, you're not alone. Discussions like these help connect personal observations to historical patterns, and they create a clearer understanding of how financial systems behave under stress. As this documentary draws to a close, the most important takeaway is that financial stability is not just about numbers on a balance sheet. It is about trust, awareness, and recognizing patterns early. History shows that banking systems rarely collapse suddenly. They weaken gradually, quietly, and often invisibly. The four-layer pattern is not a prediction tool, but a lens through which past events become clearer. The more we understand how these layers interact, the better prepared we are to recognize when similar dynamics begin to emerge. The world in 2025 is not destined to repeat the past, but the similarities are significant enough to deserve attention. Understanding these patterns does not create fear, it creates clarity. And clarity is what people need most in times of uncertainty. The next chapter of global finance will be shaped not only by policymakers and markets, but also by the awareness of ordinary individuals who pay attention to the signs that history has left behind. The future remains unwritten, but the lessons of the past are unmistakable for those willing to see them.